All right. Good afternoon, everybody. My name is Anthony Vinci. I'm a Senior Director in the Office of Financial and Operational Risk Policy. I'm here with Sarah Kenny and Mark Ramler, directors in what we call OFORP internally. Our group is mainly focused on, I guess, a couple different things. One, when it comes to the FINRA rulebook and the financial and operational risk rules, we're part of kind of the rulemaking function for that. So you might remember a little while back, those that are familiar with broker-dealers, we were working through reg notices, a liquidity risk management rule. So that's a good example of the types of things that we're working on. From a rulemaking perspective, we also obviously, since, especially for this audience, focus on financial and operational issues. A lot of our expertise, subject matter expertise in our group is related to U.S. GAAP, auditing standards, and the financial responsibility rules of the SEC. So net capital, customer reserve, books and records, financial reporting, things like that. So we're going to provide some of our perspectives from the regulatory landscape for broker-dealers. But before we go any further, just want to thank the PCOB for having us here again, and the PCOB staff for having us here today. We enjoy being able to kind of share our perspectives from a little bit of a different angle. So just to give folks a little bit more background in terms of FINRA structure. So I had mentioned that we're part of this Office of Financial and Operational Risk Policy. So we fall under the umbrella of the Chief Legal Officer, or OGC, General Counsel's Office. I would say the main function that you may hear about the most is member supervision, which has a number of different functions under it. The main ones that your clients, if you have clients that are broker-dealers, that they would face off with would be our risk monitoring analysts. They are there for every one of our member firms, broker-dealer firms. There is a risk monitoring analyst that's assigned to them, so it's kind of like their relationship manager, so to speak, but that person's also doing a lot of analysis of the financials and staying close to the firm and their contacts, regulatory contacts there on a pretty regular basis. And then examinations, so similar to inspections, examinations of firms. So we do have an examinations arm, and it's split into different what we call towers or industry groups. So we have some examiners that focus on retail firms, others in what we call capital markets, which would be like your investment banking type firms, M&A, firms like that, and then carrying, clearing naturally. So we try to break it out by expertise a little bit. And then we do have cause examiners as well. So if issues come up or we identify some kind of high risk type issue, we do have teams that'll go in upon request. We also have a market regulation arm. So in terms of our mission is investor protection and market integrity. And a lot of what we do is investor protection. I would say most of the market integrity is covered by our market regulation team, where they oversee kind of the direct trading across the U.S. markets to detect fraud and manipulation. We do have an enforcement arm. We do have a rule set, and we do have an enforcement arm. So that investigates and takes disciplinary action against firms and individuals who violate the securities rules. We have I'm sure many of you are familiar, if you have folks at your clients that you'll hear terms like Series 7, Series 27, the different licenses for securities professionals. So we do administer those licenses and have a rule book around that. So we consider that credentialing, registration, education, disclosure. So we do have a whole arm of folks that do that. We have dispute resolution services, which is essentially like arbitration type structures for administration. And then I'd be remiss if I didn't mention that we do have groups that are focused on technology, operations, strategic, and strategy groups, especially in today's day and age of data analytics and artificial intelligence. So we do a little bit more than just the exams and overseeing the firms directly. So I definitely encourage anyone to submit questions here. I'll be kind of monitoring here and heading the controls. But just to kind of give an overview, we'll hit on a few hot topics. We'll go through some recent regulatory guidance in terms of regulatory notices that we think are notable. We'll talk a little bit about exemption reports and how those work and what we're seeing out there. It is a topic we try to cover every time we're here, and given that I think 95% of our firm membership files an exemption report as opposed to a compliance report, we find that it continues to be relevant to kind of talk through, so we'll go through that a little bit. And then we'll talk a little bit more generally about oversight observations. So some of you might be familiar, in January we put out the name of the report has changed every year, but they're essentially a FINRA, like a regulatory oversight report, and it kind of goes down by topic of common findings, best practices, things like that. So we'll touch on some of those and maybe some items that aren't in there as well, and then there's some resources towards the back for FAQs and key topic pages. But most importantly, the CPE code is 840. Right, 840. All right, so we'll get into hot topics.
Okay. So I'm going to take the first two, and then Mark's going to take the third and the fourth. So the first hot topic that we wanted to make you all aware of is the SEC's daily 15C33 computation rule. So back in December, the SEC adopted this rule, which will require broker-dealers that have average total credits in their reserve formula greater than 500 million on a rolling 12-month basis, and I'll come back to that, to do their 3-3 calculation on a daily basis and make any required deposit by 10 a.m. the next day. And why was this changed, or why was this adopted? One, the whole concept of customer protection is sort of what's at the heart of a lot of the broker-dealer rulemaking, and given how much market fluctuations there can be in a week is a long time. And the idea was that broker-dealers that are responsible, they're custodying the vast majority of the customer assets, really should be doing this on a daily basis. So the measurement period for whether a firm is required to be in scope currently is from June 30th, 2024 to July 31st, 2025. So that's the initial 12-month measurement period as the rule stands now. So yes, you take that first 12-month period and determine if you are a firm that is now required to do daily 3-3. And then if the answer is yes, then you have 6 months to start actually doing it, which would be December 31st, 2025. Then on an ongoing basis, that determination is made on a rolling 12-month period. So once you're either in or out, that's not the final decision. You have to update that analysis to make sure that you do not then subsequently come into scope. I will say we are aware. The industry has asked for additional time to put this rule into effect. So the rule is effective. They've asked for additional time to be compliant with the rule. We are aware that the SEC is considering a 6-month push-out, which would change the measurement period to be calendar year 2025, with initial calculations due beginning June 30th, 2026. So we are aware that that has been requested. A couple things around the edges. I think the SEC's analysis is it looks like probably 49 firms would be affected, 9 of which are already doing daily 3-3. And there's also an ability to opt in. So there's going to be a population of firms that have to do it, and then a firm can always elect to do it. So natural question would be like, Sarah, why on earth would you want to do this daily? Well, one of the benefits is, if you're familiar with the 3-3 formula, your deposit requirement that you must have in your 3-3 bank is your total credits less your total debits. But on the debit side, just to be conservative, the firm has to take a 3% haircut. So it's not a dollar for dollar. Firms that will be doing daily 3-3 will be permitted to use a 2% haircut on the debit side. Maybe that doesn't sound like a lot, 1%. Although, if you've ever gone up 1% on the treadmill, I'd say, yes, this can be a lot. But some of these firms that are handling so much customer funds, that number can be significant. And so it may help them with liquidity and other operational types of things. So there are firms that have at least articulated that they would be interested in opting in for the benefit of this 2%. One key thing there is you can't have your cake and eat it too. So you can't do the formula daily when it's going to benefit you and then go back to doing it weekly when it's not going to benefit you. And then there's going to be just a small handful of firms that are going to be around the edges where in one measurement period they may be above the cutoff, in another measurement period they may be below the cutoff. There is transitional guidance of what happens if you go in and out of scope, but it's really expected to be probably less than half a dozen firms, so it's not a significant provision of the rule. So the takeaway is daily 3.3 is effective. It's a compliance date is coming, potential for a push off into 2026. And then I would say, because my background is from the audit side, one thing that will change for these firms and their auditors is those controls will then have to be considered to be daily controls that happen every day rather than weekly, which will increase the sample sizes of the testing that the auditors will have to do because of that daily versus weekly frequency. So I think I got everything. Anything to add on that one?
No,
okay.
you're good.
So then I wanted to move on to the electronic filing rule. And so let me just flip my notes, put my glasses on. Okay, so the SEC's electronic filing rule has sort of three components to it. So the first thing will be the method of actually filing, which will, guess what, be electronic. The second is going to be some changes to the focus, and the third is going to be a clarification on electronic signatures and how that all works. So from our perspective at FINRA, it will change nothing about how reports are filed to FINRA. What it changes is how reports are filed to the SEC. So right now, broker-dealers are permitted to file their reports electronically or manually. So they have an option to do both. Starting in June 2025, they will have to file through Edgar, and that filing can be done via a PDF. So they could PDF the annual report and file it through Edgar, but there will be no accommodation anymore for a manual filing of the annual report for a broker-dealer to the SEC. That's the first piece of the mechanism for filing. Then, somewhat later, in a phased introduction, broker-dealers will not only have to file electronically, but they will have to use XBRL. The PDF will no longer be allowed, and so that is expected to be a fairly big change for broker-dealers because right now many of them don't have XBRL capabilities, especially if they're not the subsidiary of an issuer who files their 10K or 10Qs through using XBRL. And so there will be a phase-in for broker-dealers. If they, their minimum net capital is greater than $250 million, they'll have to start doing XBRL June 2026. And if it's less than $250 million, it'll be 2028, June 30th, 2028. And so there will be a phase-in of the XBRL piece, but the accommodation for manual filings will no longer be available after June 30th, 2025. So that's the mechanism of filing. Then there's going to be a couple of changes to the actual form of the focus, one of which right now, that's probably the biggest one, is the broker-dealers required, if they're duly registered with the SEC and the CFTC, that they disclose the greater of the two required minimum net capitals. Going forward, the focus will only accommodate either the SEC or the CFTC calculation. So that is one change. So there'll be a few changes made to the form of the focus. And then the third item that this rule clarified was there was a lack of clarity about whether electronic signatures to the annual report were permitted. So this clarified that yes, they are. And as part of that, part of a broker-dealer's annual audit package is what's called the oath and affirmation. And so the oath and affirmation, the requirement to have an oath or affirmation is not changing. That page will still exist, but it no longer will need to be notarized because the electronic filing process brings with it its own sort of validation stamps of who is filing this and making sure that they're the right person. So there's no incremental requirement going forward to have a separate notarization of that page. The oath still remains a requirement, but the notarization will not be required any longer. And just one sort of housekeeping item related to that, in order to functionally be able to submit through Edgar, all the broker-dealers will have to have a .gov login for being able to transmit their annual report. And so that is something that they'll have to be getting well in advance of actually filing their annual audit report. So that is one key takeaway. Even though the dates may seem like further down the line, that login and that ability to file through Edgar is something broker-dealers need to make sure that they can do today. So that's the electronic filing rule. You guys want to?
No, I think the only thing, in terms of those of you that have broker-dealers as clients, the confirmation that was made about digital signatures being okay, I think there's a little bit involved with that, so I would, push your clients to take a look at that because there does have to be a certain amount of credentialing that's there. In terms of there does have to be a timestamp and there has to be kind of a digital certification process behind it. So it's not a matter of, opening, some sort of, app or some sort of program on your phone and just kind of like drawing out your name and then like copying, pasting it in. Like they're actually, many of you might be familiar, you go into like Adobe PDF and there's like a whole process for how you add it and it gets time-stamped and the whole bit and certified, and I think you have to confirm it and all of that. So I think it's something more similar to that, because I can foresee that being something that firms may trip up on a little bit going forward. So.
And I did want to clarify one thing. I hope I didn't misspeak, but I'll clarify just in case. So this compliance date of the filing of the annual report is for filings due on or after 6/30/2025, not for fiscal year ends 6/30/2025. So if there's a broker-dealer with a May 31st or an April 30th and they're with extra 30 days, if they are filing it, if it's due on or after 6/30/2025, then they are in scope, not the fiscal year end. Okay, so I think Mark's going to take the next two.
Yep. So I wanted to talk about something positive that has recently been developed by the SIFMA and FINRA for passive underwriters, because historically, passive underwriters, where the lead underwriters sells the passive underwriter's allotment, the passive underwriter doesn't know when their allotment has been sold. And under the net capital rule, which is moment to moment, the passive underwriter must still take an open contractual commitment charge until they receive evidence that their allotment has been sold. If they don't get any communication from the lead, that would be all the way through settlement date. Could be 2 days, could be 3 days. So FINRA, with a group of small firms and some of the larger underwriters, and through various SIFMA committees, formed a sort of a joint committee, and that joint committee came up with a template. And this template is supposed to be sent by the lead underwriter when the lead underwriter basically sells the passive underwriter's allotment. It's supposed to be sent timely. So this is in force right now. We don't know how it is operating, but the hope is that the passive underwriter won't have to continue to take a charge. Basically, the offering would take place, and then they'll get the notice, and then by the end of the day, they would no longer have an open contractual commitment charge. Now, the one thing, this template was only drafted for registered debt offerings, but they're looking to expand it, and there's no reason why they couldn't use it for equity or tax-exempt offerings. So we expect it's going to be expanded somewhat. So we look at this as sort of a positive within the industry. The next item, I think most of you know about, ASC 280 segment information disclosure. So ASC 280 was updated in 2023. It became effective in 2024. What changed? The FASB basically highlighted that segment disclosure information applies to public business entities, and broker-dealers are public business entities. So now, for this year, or for this past year, broker-dealers had to present segment disclosures in their annual reports. So we've seen a number of the annual reports that have come in from 2024, and I'd say there's kind of a mixed bag. So we see annual reports that have omitted any disclosure whatsoever. And we believe that might be due to the fact that the firm didn't believe that ASC 280 applied to them. But then we also see firms that, have deficiencies in their disclosure. And the two areas are the firm did not identify the chief operating decision maker, who that individual is. And the other is that the firm did not indicate how it measures performance for the segment. So if it measures performance based upon the income statement, then in the segment disclosure, you don't need to have any quantitative information, whereas if you measure it through some other metric than net income and the GAAP income statement, you would have to have that analysis in the footnote. However, we have not rejected any annual reports for deficiencies in their segment disclosure, at least for this year. And our risk monitoring analysts are reaching out to the firm just to give them a reminder for next year that they should have the appropriate disclosure. On a side note, it's kind of interesting. The FASB has asked stakeholders for feedback on their future standard-setting agenda. And one of the items on that agenda is the definition of a public business entity. And the question that the FASB has is, should the definition be expanded to include more entities, or should it exclude certain entities? And the comment period is open, until June 30th. So if anyone feels strongly one way or the other, you're welcome to comment.
Yeah, and saying, before we move on, just going back on the underwriting syndicate topic, so that template that Mark was referring to, that is available on the SIFMA website if that's something you want to create awareness for your clients. I think that went out in January 10th-ish, beginning of this year. So but that is freely available.
Okay, moving on. We just wanted to we're not going to go into great depth with this, but we wanted to make you aware of recent regulatory notices that have gone out from FINRA, so I'll take the first couple. So you'll probably see a theme, which is that FINRA's asked for feedback from stakeholders around basically how to make some of its rules, processes, and guidance more efficient, potentially less burdensome, less costly, and so that's broken down into a couple of different topics. And so the most recent one, requesting comments related to organization and operation of member workplaces, a lot of things around supervision and things like that. That comment period goes till June 13th. Then capital formation, which goes until May 19th, and then guidance over associated persons and what constitutes an associated person and registration and things like that. That comment period goes till May 12th. And then more of a broad one, requesting comments on a proposal to reduce unnecessary burdens and simplify requirements. So I would group those in the same theme of FINRA is looking for stakeholder feedback about how to reduce unnecessary burdens, streamline procedures, reduce inefficiencies, potentially reduce costs. So if you or a client or if you have an interest in giving feedback, those comment periods end anywhere from the middle of this month to June. So those are all asks from FINRA for feedback. The other one we wanted to make you aware of, how does FINRA, what are the procedures when there's an unexpected close of the securities markets? So this was already in the hopper when President Carter passed away, but it gives guidance about how to treat things like counting the number of days until the focus report is due, or how to handle your daily 3-3 computation if you do a daily 3-3 computation, or does the day count as a day, and all sorts of philosophical questions like that when you have a non-weekend, non-holiday, unexpected close of the securities market. And so that one was issued soon after President Carter's death, but was already in the hopper. So we wanted to make sure you guys knew about that one.
And that would apply going forward as well. So like Sarah said, it was kind of already drafted, so to speak, but we pushed it out, obviously, given the events. But going forward in the future for, similar type events that are, change kind of the market schedule short term for emergency reasons, that would govern.
So each year we issue an information notice for the various due dates of the annual audit report, the focus reports, the supplemental schedules. So it'll be for this year's is already out. It'll be for this year, 2025, and the first quarter of 2026. It's on our website, and that's also a link in your program material to the FINRA website. Regulatory Notice 2411 was just an announcement regarding many amendments to FINRA's margin rules. That's our 4210 rules. And what this notice does, it gives you a link to the amended rules, but it also gives you a comparison between the old interpretation and the new interpretation. So you can see, what changed in 4210. And there were quite a number of changes. This was changes over, I guess, maybe there were 50, 60, 70, amendments to the interpretations. And if you do have to read the margin rules, you'd be much better off reading, the FINRA interpretations than trying to understand 4210. So that's just my advice. Reg Notice 2404 just highlights all the rules at FINRA that had to be changed for T+1 settlement in May of 2024. And these rules primarily relate to transaction processing, communications, and settlements related to the time changes associated with it.
So before we move on to the next slide, there were a couple questions that came through. One was, is there a way to reach FINRA to confirm if there was or if there is an ongoing examination on the broker-dealer client and obtain the report as the auditor? So that is, we do have protocol internally on how to handle those situations, but really the way to go is to really have the auditor should be speaking to their client, and the client should be going to the risk monitoring analyst that they're assigned at FINRA, and then that can get kind of coordinated from there. In terms of like open examinations or open matters, there's limitations in what really can be shared. Typically, it's mostly closed matters that can be discussed, but open matters, there are limitations on what we can say, I think, for obvious reasons. So that's just something to be aware of. And then there was a question on if we were aware of any industry groups that are commenting on the public business entity definition in terms of broker-dealers. I'm personally not aware of if anyone has commented. Typically, I feel like those comment letters tend to come in on like the last day that they're due. I haven't actively checked, but I haven't been made aware through discussions if anyone's commented as of yet. So, okay. CPE code 492. 492. I feel like I'm doing bingo. All right, exemption reports.
Okay, here we go. So we continue to get quite a number of questions about the exemption report, and it probably makes sense. And this is internally and also externally, and it makes sense because probably 95% of our members file an exemption report. So what I thought I'd do is just go over some key concepts and key considerations. So first, you got to say, what's the purpose of the exemption report? It's really a source of information for FINRA, for the SEC, if a firm is being inefficient related to the protection of customer assets. You can't draw any conclusions from that. It doesn't mean that the firm is not compliant with, paragraph K or anything else. It's just information. And the report covers all the business activities of the firm, and how it operated for the year. And there are two different types of activities, right? There are covered activities, which are covered under 15C33, paragraph K, and there are uncovered activities, which is everything else that falls under what's called footnote 74. So let's first talk about the covered activities. So there's three categories of covered activities. So you have K1. Now, K1 exemption, and this is what 15C33K does, it exempts a firm from having to perform a reserve computation, and being subject to possession or control. It's for firms that are not carrying customer accounts. So a K-1 firm has an exclusive exemption. And what that means is all that firm can do is sell mutual funds or variable annuities. A firm that is operating under K-1 cannot do any other securities business whatsoever. If a firm was also doing investment advisory, they could not claim K-1. They would likely fall under footnote 74. And we do see firms claiming K-1 when they do have other brokerage operations. Now, K2I is not exclusive. So you could be a K2I firm and a K2II firm and a footnote 74 firm, but it is specific, right? So K2I is for firms that self-clear, who carry no margin accounts and settle customers' transactions through an account for exclusive benefit of customers. And these will be your DVP, RVP firms. And it will also be what's called the 15A6 chaperoning firms who chaperone a foreign broker, because that chaperone has responsibilities under 15A6, and therefore they have to adhere to K2I and capital and certain capital requirements. So they fall under K2I. But nothing else falls under K2I. And many years ago, FINRA and the NASD, when they didn't know where a firm fell under, if it was an M&A firm or something like that, they exempted those firms under K2I. Footnote 74 didn't exist. So the fact that a firm may have in their membership agreement that they're K2I is irrelevant. It's really how did the firm operate? Does the firm self-clear? Are they settling DVP, RVP transactions, or are they chaperoning 15A6 transactions? Those are the firms who should claim they operated under K2I. And then we have K2II. We don't see any issues with that for firms that clear on a fully disclosed basis. You know, that's pretty straightforward. So those firms then have to state whether they complied with the exemptions or exemptions without exception or with exception, right? So if they had exceptions, they're supposed to list those exceptions. Now, like, what is an exception, right? So generally, we see, you know, for a K2II or even a K2I firm, you know, the exceptions are going to be related to prompt transmittal of customer checks, where the firm did not promptly transmit the customer check within the required time frames. However, an exception is anything that's inadvertent, right? If a K2II firm, you know, received customer funds and held it for a short period of time and then, you know, sent it on to the, you know, the clearing firm, that was inadvertent. They don't operate that way. That would just be an exception. Now, when we look at non-covered activities. That's basically all the other activities that a firm does as a broker-dealer. Proprietary trading, match book, conduit book, direct mutual fund business, M&A, et cetera. So there are AICPA, SIFMA template of what the exemption report should say under footnote 74. And the SEC FAQs, which we have linked there, also give you some language, and they list certain activities, but those activities are not exclusive or inclusive. If the firm is not doing any of those activities, then they don't list them. They list the activities that they're operating as a broker-dealer there. And then the key point is, for footnote 74, was did the firm has to state they did not hold customer funds or they promptly transmitted customer funds. And when we talk about promptly transmit, there are certain activities where you have a prompt transmittal requirement, such as direct mutual funds, direct variable annuities. You have to promptly transmit checks, or contingent escrow offerings. You have to promptly transmit that as well. But if a firm wants to claim that they're exempt and they held funds under footnote 74, if they held funds inadvertently, like we said before, then that would be an exception, and they should report an exception. So you may end up holding funds, but that's not how you operate. If you operate to hold customer funds, you may not be able or eligible to file an exemption report. Now, it is, the rule is self-operative. The firm has to make the decision as to whether they believe they have a basis to file the exemption report. So that's something to consider if you have a firm that holds customer funds and operated in a way. What is the basis for them to be able to file an exemption report under 17A5? And each situation is going to be facts and circumstances.
So lots of discussion around exemption reports on a pretty regular basis. We only have 4 minutes left. First of all, CPE code 574. And 574, can't miss that. But I'm going to ask Sarah just to create some awareness around the oversight report. And then there are a few questions in here that I think will be relative quick hits, so maybe we'll take the last couple minutes on going through those.
Sure. So again, more of an awareness than a deep dive here. We wanted to let you guys know that at the end of January, FINRA issued their annual regulatory oversight report, which is their way to give some transparency into the regulatory operations programs and the results of those programs for the year. So that report is up on the FINRA website. There's a number of topics covered, anything from AI to books and records and consolidated audit trail, but the financial management section would be the one that's probably most relevant if you do live in the broker-dealer world, specifically the findings related to 15C3.1 and customer protection. There are some specific, not only common areas of findings, but also some best or good working practices So sort of the flip side, where FINRA recognized some good operational procedures in that 3.1 and 3.3 world. So we just want to make you aware that that is up on the FINRA website, and that section is directly relevant to the broker-dealer space. And so it's available right on the FINRA website.
Awesome, thank you. So in terms of the question, just for these last couple minutes, one question was, as it relates to daily 3.3 computation requirement, would it make sense to have a threshold or an early warning level where borderline firms should be considered to do daily 3.3 comps for closer scrutiny? So I think the idea there is, hey, if there are issues where someone's deficient on a regular basis, can FINRA or the SEC mandate them to go from weekly to daily? So I mean, as the rule is structured right now, as it's going to be rolled out, there's very specific, average of 500 million in total credits, and that's kind of where the line gets drawn. But our program on both from member supervision in general is a risk-based program. So we do, as you would imagine, we would more closely monitor firms that we would, for one reason or another, assess to be of a higher risk, and often that may mean maybe more frequent reporting from them. And there are other things that, through the FINRA rules that we would have the authority to look at if the circumstances were to warrant it. Happy to say we don't have to do that frequently, and we're very judicial about how we kind of go about that. But I think that's kind of where that would probably fall into. Follow-up question on the exam report. So that this was the question before about getting a copy of the exam report from the auditor or talking to the auditor about findings. It was, is it possible to contact the FINRA rep on the exam matter directly to ensure the independence of the source as the auditor? So unfortunately, no, we can't provide that to, without the firm's knowledge. However, the report is issued to the firm, and presumably the auditor would request that report from the firm, so it will be part of the documentation or part of the books and records of the firm. Now, if you wanted to confirm the validity of that, of course, you could get on a joint call with your client and FINRA, and FINRA could let you know, like, yes, we issued this report, yes, these were the findings, things like that. So that might be the way to go on that, just my suggestion. And two more questions, because they are good questions. I want to make sure we touch on them. I know we're a minute over, but if it's okay, we'll wrap up with these two. One of them, any thoughts about amending the required audit letters in connection with extension requests by clients? So this, I believe, is referring to if your client requests from FINRA an extension on filing their annual audit report, and part of that requirement in terms of our policy and in the interpretation in 1785 says that you have to get a letter from your auditor saying that there's no material weaknesses, and what kind of the status of the audit and the reason for the extension. I would say in those types of situations where you feel like you can't answer those questions, or maybe you can't give wholesome conclusions to that, have the firm discuss that with the risk monitoring analyst. I think we realize some of the gray area there and the ask, and it's something that we are discussing internally. I don't know how that will turn out or when, but I would say that even if you don't check every box of what you need to put in that letter, I would encourage an open dialogue with the risk monitoring analyst of the firm. And where we can, we try to exercise some discretion. So just something to keep in mind. And the other question, I think this is related to exemption compliance reports. So it says, any direction for filing 1 or 2 reports related to a broker-dealer that has introducing business with a fully disclosed clearing firm and also carries customer accounts. So if you are, say, doing if you're doing full clearing carrying for customers in an equity business, and in the same legal entity you are fully disclosing fixed income activity to another broker-dealer, because the legal entity is already carrying customer accounts for at least part of their business, you're in a compliance report. So you wouldn't issue both reports. For one time period, it should only be one or the other. The only situation where you might see there be two reports in a pack is if the firm maybe changed their business during the year and they went from, hey, we were totally fully disclosed January to June, but July 1st we flipped a switch and now we're clearing our own accounts and we're custodying customer accounts. In that scenario, we likely would get an exemption report for the first 6 months, a compliance report for the last 6 months. But they couldn't overlap. I want to make sure we don't have any more CPE code. Yeah, we do. And we have another CPE code. 555 is the easy one to remember. 555. And in the resources, we have a number of links for key topics and FAQs in here. There is a wealth of knowledge on our website. I haven't even been through all of it, frankly, but I feel like we're adding stuff daily. But it's a good place to go. So, anyone here in person, if you have any questions, feel free to come up to us and chat. But otherwise, thank you again to the PCOB for having us. We'll see you next time.